Today's episode is brought to you by Taft Law and its Franchise Advance program, a one-of-a-kind program developed by your host, Josh Brown, to help entrepreneurs assess, convert, and grow your business the right way through sound franchise structures. To learn more, go to taftlaw.com and type Franchise Advance Program in the search bar.
If you think like, act like, or are trying to grow like a franchise, then the Franchise Euphoria podcast is for you. Hello and welcome, everybody. Josh Brown here, and I created this podcast for one main goal: to help people who are trying to grow their business through franchising or franchise-like structures to do it the right way. I've been practicing law now as a franchise lawyer for many, many years, and I've seen it done the right way and the wrong way. And this podcast is not filled with a bunch of legal mumbo jumbo. Rather, I talk with real people, people who have been there, have done it, are doing it right now. And I also dive deep into specific topics related to franchising. So if this is of interest to you, you are at the right place. Enjoy. Welcome back to Franchise Euphoria. Thrilled today to have on Grant Ferguson from the UFS business called Unsecured Funding Source. Grant is a growth expert, change agent, and innovative leader. As the CEO of UFS, Grant works with business owners and entrepreneurs to navigate the increasingly complex world of lending and finds the best solutions to meet their capital needs. How you doing, Grant? Welcome to the show.
Hey, I'm doing great, Josh. Thanks so much for having me. Glad to be here.
Yeah, so I love this episode because, in this day and age, there's lots of different lending options. There's not lots of different unsecured lending options. There's some. So I look forward to kind of diving in to that aspect of what you all do. But before we do, give a little bit of background on your background in banking and your other business experience that kind of led you up to this point.
Yeah, Josh. So I've got kind of a very unusual background in the sense that I've done some really entrepreneurial things, some startups, and I've also spent quite a bit of time in corporate America, working for some very large, Fortune 50 companies. So I have got experience across a broad range of industries, but as you say, in particular, I've worked in lending. I was headed up marketing for the mortgage company at JP Morgan Chase for about 5 years. And then I spent quite a bit of time, about 10 years in consulting, working with the likes of Wells Fargo and Bank of America and a range of other different lenders. And then, finally, I just decided that I wanted to get back into running and operating and growing a company again. I'd launched a startup early in my career over in Ireland, a call center company, right around the time of telecom deregulation. And as a lot of your listeners will understand, when you're an entrepreneur, it's kind of in your blood. It's just something that you can't get away from. You always want to be out kind of doing your own thing, being your own boss and growing a business. And so that was always germinating in me, even though I spent some time, in the corporate, the safe corporate womb, I suppose. I was always looking for a way to get out. So just to bring you up to speed, what I did, I spent a couple of years looking to instead of start a business, to buy a business. So, I'm sure you've heard of this sort of idea of entrepreneurship through acquisition, which has been pretty popular. The idea that entrepreneurs, rather than going and doing a tech startup or kind of begging and borrowing some capital and living on ramen noodles and popcorn for a while, which seems to be more suitable for people in their 20s.
Now, don't knock that, man. Don't knock that. I mean, that can get you pretty far,
yes,
ramen noodles and popcorn.
It certainly can. Yeah, it certainly can. You could probably lose weight as well as grow a business. But, I think for me, I was just at a point in my career where I wanted to do something entrepreneurial. And I just began, though, to look at the idea of buying a business rather than starting one from scratch. The advantage of buying a business is that, you've hopefully got, good cash flow and revenue, and you've got a product market fit has kind of been figured out. You've got staff in place. You got maybe a bit of a brand name, and then you can kind of jump in and grow it. And for me, I wanted to bring my, background to bear and help to digitize the company, help to professionalize it, and just really help to expand it. So that kind of brings us up to Unsecured Funding Source, which I identified and bought 2 years ago as just as you say, in the lending space, very much a niche lender, focusing on business startups, acquisitions, and franchise purchases. And it's been a great ride so far, and grown the company by almost 4 times where it was when I bought it. And that it has been just a lot of fun and a lot of challenge, and really been kind of cool to be in this whole space.
And so you guys are looking at making loans to business startups, whether and acquisition purchases, as well as, obviously franchise related purchases. I know that I believe historically UFS was sort of an in between, where you would connect with a business and then connect them with a lender. Now Right. You've gotten more into direct lending. Can you talk about sort of the history there and the transition into direct lending?
Yeah, that's exactly right, Josh. So when I bought the company, it had been around for over 15 years. Over that time, had facilitated about $500 million in lending, unsecured lending, for exactly as you say, business startups, acquisitions, franchise purchases, and so had been very successful in doing that. Basically, matching borrower with bank, right? Looking at a client's needs, working with over 250 different lenders around the country. Credit unions, big money banks, alt lenders, online lenders, and really helping to put together the best packages in terms of rates and terms and so forth for their needs. So I like that business model. I think it's a very legitimate and, and robust business model. I don't think it's going to go the way of, the travel agent anytime soon. But I also knew that I wanted to pivot the business towards doing direct lending, just because I think it's a more sustainable model. There's obviously more revenue in it over the long haul. And it's just something that adds value to the business, where you literally add loans to your balance sheet, right? So what we did is something that's become much more common today in the fintech space, is to go and find a sponsor bank. A bank that will allow you to lend under their charter. And so underneath that banking charter, and the bank that we work with is a member of the FDIC and all of that good stuff, we can begin to originate loans and have a lending line available to us, so that we can do our own in-house underwriting, in-house approvals, and set people up to be funded. And what I love about it, apart from the business benefits of the business and growing, helping us to grow, is it just gives us a ton of flexibility to really design loan programs specifically around this target market, the kind of flexibility they're looking for, the kinds of loan terms, the kinds of loan amounts that they need to get themselves started, which really don't exist out in the market today. It's been a notoriously difficult space to play in and to find money in, is that whole startup and acquisition space, because obviously there tends to be more risk associated with it. So a lot of conventional lenders, don't want to touch it. So, yep.
Yeah, exactly. You hit on that. Like that's a good jump. That's a good point I want to touch on too, is obviously you hear unsecured funding source, which obviously is a great name, right? It tells you exactly what you do. But at the same time, to me and to probably others, it screams, lower risk for the person borrowing the money, higher risk for you. Right. Right. That's so. How do you balance that? How do you balance? You have a bank. It looks like, what is it? Little Horn State Bank?
We're currently working with them and a syndicate of other banks through them. But they're a 100-year-old bank in Montana. Also happen to be one of the most progressive banks out there. So that's pretty cool. And being a Montana-based company ourselves, it's been kind of a fun story. So, but you're exactly right. So as as I'm sure many of your listeners know, the interest rate is really nothing more than an expression of risk associated with a loan. So the higher the risk, the higher the interest rate. The lower the risk, the lower the rate. So what you find with unsecured loans is of course, the interest rates can tend to be a little bit higher. And there can tend to be more requirements up front in looking at the borrower. The reason that we do it this way, though, is that we're of belief, and there's some good statistics that bear this out, from the lending industry, is that it has a lot to do with an individual's character as represented in their credit history. And basically, if somebody has got a 750, 800 plus credit score, low debt to income ratios, good income, good liquidity, the likelihood that they're going to take a loan and just decide to stop paying it or default on it is very, very low. They've demonstrated through their past, sort of financial behavior, if you're like, their fiscal responsibility, that they're a good bet. And so what we do is we give a lot of credence to, and we put a lot of weight on the personal credit worthiness of an individual that's starting a business, buying a franchise. And the reason we do that is because you have, unlike, when you're buying a house, you don't have a hard asset that you can collateralize the loan with. So you kind of have to look at a lot more at the jockey and a little bit less at the horse, even though the horse is also important. Is it healthy? And, is it going to win the race? Are we going to at least finish the race? So,
well, yeah, you're more secure. I mean, you got a house, somebody's got a house. You look at the comps, you look at, if you're a bank, and you say, okay, worst case scenario, this house is worth this. Here's the equity in it. And if all hell breaks loose and, as they say, what hits the fan. Hey, at least we got a house we can go get and go sell and get, our money back. Or well, you don't have that, right? So you've got to do a lot of due diligence on the background of the person and on the business itself, right? I mean, you got to look at the business and go, okay, this could be the best entrepreneur. This could be somebody with a great track record, but what's the viability of this underlying business going forward?
Right, exactly. And there's always a level of risk and uncertainty associated with a business, in all cases. So somebody who's coming in to buy, a business, let's say they want to buy a laundromat in a particular city, and they don't have any background in ever having run a laundromat. However, they have had mid-level or executive level experience working in corporate America. They're looking to get out and do something differently. They've got great liquidity. They've got low debt to income ratios. They've got, a great 401k. These are all things that we look at and we weigh and we say, you know what, we're going to take a bet on the person. We're going to take a bet on the jockey, as it were. And we also know that the business they're getting into has got some trading history. It's, unlikely that it's going to go bust unless they really go in and mess things up. And so we feel comfortable with that as well. But what it does is, because these are areas, the startup space and the acquisition space are areas where it's particularly difficult to get funding, we kind of overcome that by putting a lot of increased emphasis on the borrower and on the individual. And then, of course, we do other things like we'll take a UCC filing, against the business. And, we'll also kind of look very closely at the business financials to make sure that it, cash flows out and there's the right debt coverage ratio and things of that nature. But what we don't do, unlike SBA and conventional lending, is we don't collateralize that loan with that individual's home or other assets. And that gives us a lot more flexibility in being able to fund people that might otherwise not get funding. And the other thing that's worth mentioning is, we tend to do everything below 500, so 50,000 to about $500,000 in terms of loan size on the direct lending programs that we offer. We're 50 to about 250,000. So we're talking about relatively small loans where an SBA program will go up to 5 million. So for that reason, it also gives us more flexibility. Not that we can afford to see any loans default, but we're not talking about a multi-million-dollar loan defaulting if that's the case, right?
Are a lot of these term loans, like, in other words, you have an interest component where maybe for a period of time they're interest only, but then, it's a term loan that they've got to pay back within 3 years, 5 years, whatever, or is it just interest only, or is it a combination of a set payment each month that combines interest and principal? I mean, what's typical for these kind of loans?
Absolutely. So we do term loans only. Most of what we do is kind of typically 5 to 7 years. Term loan, our Jumpstart loan program, which is the direct lending program that we just recently launched, as you'd mentioned, in conjunction with Little Horn State Bank, we do 10-year term loans. There will be an interest rate that, again, is associated with the level of perceived risk on the loan. Those tend to be the interest rates that are kind of out there today. As we well know, just very recently, the Fed announced another increase. So prime is at 7.75%. We tend to be somewhere in kind of the low 10 to 12% rate, which for an unsecured loan, non-collateralized loan is a very competitive rate in today's market.
That's really competitive.
Yeah,
that's really competitive.
Yeah, as you say,
explain a little bit for the listener, because we throw out these languages like term loan, this and that. I think you and I know what that. Break that down, what that actually means for a small business owner, an entrepreneur who calls you up and you say, hey, we can get you $250,000. Here's what we're going to do. It's a term loan and it's got to be paid back over 10 years. Explain how all that works.
Yeah, it absolutely is. So it's very similar to a mortgage in the sense that you'll have a term on most people's mortgages would be on a 30-year term, maybe 20-year term, some are 15 years. But it is a fully amortizing loan. What that means is that your monthly payment is going to include a portion that goes towards interest and a portion that goes towards principal. And so by the time you get to the end of the loan, it's fully paid off, right? So you're paying off.
And so there's no lump sum. There's no that's the thing I like for those, because the monthly payments will be higher, but at the end of the day, somebody's not stuck with the good feeling for 4 years or 4.5 years paying interest only. And then all of a sudden at the other day, they look and they're like, holy cow, I owe $100,000 in the next 6 months.
Yeah, absolutely. Yeah. We don't do any balloon payments. These are all just amortizing loans. We also don't touch the credit card side of the business. There are a few companies out there that would be considered competitors to us that help people with startups. But what they do is they help them go out and get a bunch of low interest or zero interest credit cards, right? Cash those cards out and then, maybe get the cash they need to make the purchase. Well, what happens, of course, is, 9, 12, 18 months in, all of a sudden, all these cards start kicking in. The deferred interest periods are over, and these people are left with multiple thousands of dollars in credit card payments, that are due. We just don't think that's a good way to start a business. As an entrepreneur, one of the biggest concerns you always have is cash flow, especially when you're in a ramp up period. There's typically a burn rate that's going to apply where you have to be able to cover your nut and in addition to that, your personal living expenses. Otherwise you might put your marriage in jeopardy. So you've got to know that you've got a burn rate. You've got to be able to cover those costs as you begin to ramp up the business or grow the business and so forth. So I think that's a really excellent point, because I think that, to your point on the 50 to 250,000, and speaking from the franchise perspective, most franchises that have a retail component or a build out component to them are going to cost, somewhere north of that. I mean, not all of them, but somewhere north, after you factor in franchise fees, build out, whatever the case may be. I mean, some won't, but I think the theory is, from my perspective in the franchise world, the number one thing that kills franchisees is they run out of capital and or they run out of access to capital, right? So, I mean, they get the thing going, they spread themselves way too thin. It costs more than anybody ever thinks. And so, maybe that wasn't factored in. And then all of a sudden they just don't have enough money to finish it up. And so where you come in is sort of interesting, because, it might be, and I'd be curious your thoughts on this, it might be that there is a secured component to this, that there is a secured loan that they're already working with, and you're coming in as sort of additional cash flow for that purpose, saying, hey, as we get this franchise going, we know that for the first 6 to 9 months, there is going to be a faster burn rate.
because you're building up customers. Ideally, you're spending money. You're spending money faster and on things to get things going. You probably got more spending on advertising. You've got more spending to bring people in. You've got more spending to get the word out, in terms of marketing and social media and all that stuff. But yeah, you don't have that customer base built up to offset it with the revenue. So you need to have that spread filled out pretty well. And maybe you have a loan to get the build out, but then you guys come in and say, okay, this will help get you through that 6 to 9 month window.
Right. Yeah, exactly. I mean, just as you say, it's, things always take longer and cost more than we expect them to. And that can be very frustrating for a new franchisee and somebody sort of starting to ramp up. Like I was saying before, we just believe in predictability. So if you borrow this much money at this rate over this term, this is exactly what's going to cost you each month. And you go into that knowing that this is the nut that I have in order to service this debt. And we think that's a really important way to start, a business and to be able to manage cash flow. Now, as you say, having access to capital is oftentimes going to be based on, especially in a startup situation, your own personal credit worthiness. So a lot of our loans don't report to personal credit. They're going to be business credit. There's going to be a UCC filing against the business, although they're heavily weighted on the personal credit worthiness, as I'd mentioned. That does give an individual, an entrepreneur, a franchisee, some flexibility to take on personal debt if they need to do that in order to help them, cover costs.
Well, that's interesting. So you guys are so what you're saying is that loan in and of itself is going to be based purely off of the business. And so to the extent that, that it's not going to impact them on the personal side, they still could take personal loans if they wanted to. They could go utilize personal loans, but yours is going to be focused purely on the business side.
Right. And that's exactly right. I mean, and yet at the same time, and this is why it's such an interesting space to operate in, we're approving them on the basis of their personal credit, but we're tying that loan to the business. So it is a commercial loan. The way that I sometimes explain it is it's a personal loan for commercial use, right? So you're getting it before you have a dime in revenue. But the reason that we like working with franchises, of course, is that, the FDD, the franchise disclosure document, if it's done right and it's done well, really does give us a pretty reliable sense of what first year, second year cash flow and earnings look like, of what the failure rate looks like, et cetera. And so we feel like we're making a really good bet. The other thing that we do is we do work closely with the franchise brands, the franchisors, who clearly have a very vested interest in a franchisee being successful. And, they, in the long term, make their money from royalties. They don't make their money from the franchise fees up front or anything like that. They make their money on the long-term success of that individual or those individuals. And they also grow their brand, organically through word of mouth and through, success of franchisees. So they are extremely vested in seeing this person be successful. So we like to work closely with these kinds of brands because we all have the same goals and the same ends in mind.
So you might tie in with a franchisor brand, and then when they're talking to franchisees and they're working, and franchisees inevitably say, hey, do you have any recommendations on where we go for funds, for loans, so forth? The franchisor can say, here's several options. One being, unsecured funding source, and then that can tie into them calling and seeing if it's a good match. Is that what you do on the franchisor side?
That's one of the ways that we work, Josh, and that's more of a referral-based or preferred partner-based relationship. But what we're beginning to do now is we're actually developing in-house or sort of captive lending programs. And what that means is that we're working directly with brands that say, hey, we want to, brand X, we want to offer a brand X financing program, and we want to do it with Unsecured Funding Source, our company in the background, providing the underwriting and the approvals and the liquidity and the funding to make that work. And so it's kind of a shared risk and reward model. And what's really great about that is, we can really open up our credit box to get more people approved on that basis, knowing that the brand is really stepping up and saying, we want to be part of this program, and maybe carry some of the risk and also get some of the returns from the lending portion of it. So it's a lot. It's not necessarily that brand couldn't work with a different partner if it's an SBA loan or it's a loan amount that goes beyond what we can do, but really it just becomes another way of differentiating themselves, for us to be more kind of embedded in their business and working really closely with their franchisees. So we work in both ways. Preferred partner, give these guys a call, or hey, we have an in-house lending program and we're kind of the engine that powers that.
So in our remaining few minutes, I want to talk about a couple of different things. One is I want to see kind of where you're going in 2023, what your goals are for the next 12 to 24 months. And then, to finish it off, I just would love to get your thoughts on, the environment right now for franchisees, franchisors, and sort of the whole lending arena. But so let's start with what's the goal here for Unsecured Funding Source over the 2023?
Our goals, and we spent some time early this year in strategy sessions, is really to be seen as the premier alternative to SBA lending for loan amounts from $50,000 to $500,000. And we think that that's a space that there is, it's a gap in the market. Generally speaking, as you'd mentioned earlier, most franchises are kind of $100,000 to $300,000. There's obviously many that are much higher than that and some that are lower than that, but that really is sort of the sweet spot. Interestingly enough, the price of a Main Street business, if you're looking at business acquisition in this country, has kind of hovered right around $320,000, $350,000 as well. And that's where the biggest gap is in financing, right? Most people can cobble together through personal liquidity, maybe friends and family, they can cobble together maybe 50, 100,000, let's say. But if you go to the big SBA lenders, they're at about $1 million in terms of the loan amounts that they do. Some of them will go down to maybe 300, 250,000. So you've got that gap in between that kind of 50 to 250,000 that we are very, very hyper focused on. So that, I think to answer your question, that's really our goal, is just to be seen as the go-to company for alternatives to SBA lending in the franchise space, and to develop out a whole host of in-house captive lending programs with brands, just as we're doing today, but to really expand that significantly this year. And we definitely would like to grow significantly. As I mentioned, since buying the company, I've grown at 4x. Would like to grow that, continue on that growth trajectory, through the end of this year, and just develop more visibility and really, thought leadership, which is why we very much appreciate being on your show, on your podcast today, is just to begin to kind of look at, there are many alternatives out there beyond just going straight to your local banker or to an SBA lender. And we want to be part of helping inform that, helping to talk about that, and then helping to kind of close that gap for franchisees as well.
Well, not to beat up on banks too much, because I do love them and I have a lot of relationships there. But my tagline for all banks should be, I said, every bank should have this tagline: we're here when you need us the least.
Right, exactly. The old banks will typically give you money if you can prove that you don't need it, right?
Yeah. If you can prove to us you don't need any money, you're well collateralized, you've got all your ducks in order, hell, we'll lend you anything you want. So we're here when you need us the least is sort of the tagline I think every bank should adopt. In finishing up this grant, tell me about where you think the market's going here over the next, and I'm not asking you to predict anything, but it's always interesting to me. I've lived through in the franchise world on the legal side a lot of up and down economies and markets, and franchising seems to stay a little bit above the fray. Not that it's not impacted, but there's somewhat of a stability there from the perspective of the idea behind a franchise is that it's a proven model that it's system based. And so, when you have times where a lot of people, lose their jobs or are laid off, they take their nest egg and they invest it in a franchise. Or, when you have people who think about starting a business, a lot of times they look to franchises because they have the sense, it's not always true, but they have the sense that they have a better chance for success or something like that. That at the end of the day, what we all know is your chance of success varies depending on how good of an operator you are, what the business model is that you have. And yes, the franchisor system does matter in that equation, but you can't put too much of the onus on just the system. These things don't run themselves. I don't care what business it is. But tell me where you think things are going here, because I don't know if this is factual or not, but it seems to me there's more lending options now than I've seen in recent memory, right? I mean, you have all the traditional sides, but you have all these other online sort of places where, they make it seem relatively easy. Hey, just come on in and we'll just throw money at you. We're just sitting here on cash. We're going to throw it at you. And while that can be potentially good for the short term, it also can be bad if you don't have a strategy around why you're getting the money, how you're going to spend the money, and how you're going to use it to ultimately grow your business.
Yeah. No, that's exactly right. I mean, I'm an entrepreneur myself, so I can very much relate to individuals that are sitting, looking and considering maybe stepping out and buying a franchise, leaving the day job and going and doing something different. And what I would say to somebody like that is, is the price of money right now high? It is, but it's going to get higher, right? It's not, you're not going to get money as cheap as you can get money right now. It's also by no means as high as it has been in the past. And I always say to people when they sort of, get into discussions about interest rates, it's like, well, what you shouldn't be looking at the price of money. You should really be looking at the cost of doing nothing. What is the real opportunity cost of you staying in the job that you hate or that you've been wanting to get out of for years? What is the cost to you and to your well-being and to your ambitions and to your family and to wealth creation of waiting that out and kind of seeing how things go versus just diving in and doing it? I personally believe that now is the time to act if you've got a vision, and it's time to move forward and not worry about things like, interest rates or the various vicissitudes of the market, because those are always going to be there. There's always going to be 100 reasons not to do it. And I think, to focus on how to get it done is the right way to go. Now, I think you should be wise in terms of timing. We always encourage our clients that we are working with not to quit their day jobs yet until they've secured funding, until they've got a plan in place, to kind of go out and make that happen. But we also encourage them to look, again, as I say, at the cost of doing nothing, which is much, much higher than, the cost of the money that you're going to need to get in order to make that happen. We are definitely noticing a little bit more of a wait and see approach. It's a big purchase. It's a big decision. Some folks are kind of waiting a little bit on the sidelines and considering, whether they should kind of take the leap and get on with it. But again, we always look at the overall picture. And once you start, even if you factor in the cost of money, and you look at what that's going to cost on a monthly basis, and you look at the cash flow, and then you look at the likely success you're going to have, as you say, in a trusted, proven brand with systems and processes and a track record. Once you go back and look at that versus what it costs you to get into that business and get it going, really there's no argument, right? It's just, go do it and make it happen. And again, back to your point as well, right now, because interest rates are a little higher, banks are really keen to lend, right? Because they're able to make, quite a bit of money lending right now, versus an environment where the rates are lower. So they are eager to lend. Being a lender and being on this side of the fence, if you like, versus somebody looking for money, although I've spent plenty of time doing that as well, I can tell you that lenders are typically looking for reasons and ways to get borrowers approved. That's the bottom line. As you say, prove, there's many traditional banks that would say, prove you don't need the money and we'll give it to you. And that's definitely how it feels. But I will say that you don't make money as a lender unless you're lending money. I mean, that's the bottom line. So unless you're lending money, unless you're booking loans, you're not making money. And despite other products, obviously, that can be revenue generating. So they're looking for reasons to get people approved, not for reasons to turn people down. And that's very much the boat that we're in as well, right? We're looking for well-qualified borrowers that have a good business plan, a good solid franchise model, that have great, creditworthiness, that have great track record, and that we can help them get that $50,000 to $250,000 they need to get out and get going and begin to realize their dreams.
Well, if you'd like to learn more about Unsecured Funding Source, you can go to unsecuredfundingsource.com. That's unsecuredfundingsource.com. Thank you, Grant, for coming on. Before we finish, I kind of have maybe a last question or two that I want to pop in here. Tell the listeners what the process is. I mean, how long is the process from start to finish if somebody reaches out to you? I know some of it will depend on, obviously, them getting you documentation of things, but generally speaking, how long is the process from when they first reach out to you having a decision on a loan?
Yeah, no, it's a great question. Thanks for asking it. It's a lot shorter than your typical SBA or conventional lending for sure. We can typically get somebody pre-qualified for a loan within 24 hours. And then, as you say, once we get all the appropriate documentation in place and we get that reviewed by underwriting and by our loan committee, we can get somebody approved, usually within 48 hours for that. And then we can also, we'll get somebody, if they want to move forward, we'll get them their loan documents and get those signed, and we can get them funded within 48 hours of that. So really start to finish, 5 business days would be about the quickest it can go. But on average, we find that folks are kind of in the 1 to 2 weeks from sort of start, to funding, if you like. So a very quick process, assuming everything falls into place and people engage and get us what we need.
Well, look, I really find this model interesting, to be honest. I find your business interesting, and it's because, in most cases, most people don't just have all the resources laying there ready to go invest in a business. At a certain level, you're going to have to take a risk. You're going to have to borrow money. You're going to have to go, put it on the line a little bit, right? I mean, that separates the people who talk about doing something versus the people who do something. But at the same time, I think you got to be smart about it. I think you got to be smart about what your calculated risk is, to what you said earlier, which was, don't just go quit your job and hope for the best, right? Have a plan in place to do this. But I do like seeing these additional funding sources that come about. And so it's been very enjoyable speaking with you, and I look forward to hearing how these next 12, 24 months and beyond go. So really appreciate that, and best of luck to you in the future, Grant.
Thank you very much, Josh, for having me today, and we really appreciate it, and love that your show is out there and enjoy listening to it. And again, thanks very much for having me.
Thank you so much for tuning into another episode of Franchise Euphoria. If you enjoyed it, please head over to Apple Podcasts and leave a rating and review. It really helps to get this show out to more and more people. Also, if you have any questions, have ideas for guests or topics, please email me, josh@indyfranchiselaw.com. That's josh@indyfranchiselaw.com. And finally, please note that this podcast is for entertainment and educational purposes and is not in any way, shape, or form meant to be any kind of legal advice. If you're seeking legal advice, please contact a lawyer. Have a great one. Happy franchising.